Today, we're going to explain a crucial aspect in trading: setting the correct stop-loss level, take-profit target, and understanding when and how to trail our stop-loss. So, let's dive right in. First and foremost, let's talk about setting a stop-loss level. The stop-loss is your safety net in trading. It's the level at which your trade will automatically close if the market moves against you, limiting your losses. It's a crucial risk management tool that helps protect your capital and minimize potential drawdowns. When setting your stop-loss level, consider factors such as your risk tolerance, trading time frame, and the volatility of the market. Here are some key considerations for setting stop-loss levels. What type of trader are you? It's important to figure out what type of trader you are. Are you a day trader, a swing trader, or long-term investor? And you might be asking, why does this matter? Because how you trade will help you set the correct take-profit target, stop-loss level, and if you are going to trail your stop-loss or not. Day traders often have quick stop-losses and take-profit targets. They usually don't trail their stop-losses. Swing traders, on the other hand, look for bigger changes in price, leading to higher risk-to-reward ratios. They allow more flexibility for both stop-loss and take-profit levels. They also adjust their stop-loss as the trade goes on. Long-term investors, though, have a different approach. They may set a stop-loss, but they're looking at profits that could take years to achieve. The most important factor for setting a stop-loss level is to identify support and resistance areas, trend lines, chart patterns like double tops or bottoms, previous lows or highs, as well as key technical indicators to determine optimal stop-loss placements. Check the previous videos where I talk about support and resistance areas and trend lines in the description below. Also consider whole numbers. For example, 300 instead of 290 or 310, or 350 instead of 340 or 360, etc. These are psychological numbers, and traders or investors are looking at those numbers to take profits, exit trades, or set stop losses. You should also avoid placing stop losses too close to your entry point, as this may result in premature exits due to market noise. A key technical indicator you can use to decide where to place your stop loss is the moving average. It can serve as both support and resistance level. If you want to learn more about how to use moving averages and some trading strategies with them, be sure to check out my video on the topic. You can find it up here or in the description below. Lastly, think about how volatile the market is and change your stop-loss levels accordingly. You can't just say, I'll always set a stop-loss of 10% for every asset I trade. For instance, in foreign currencies, a 10% stop-loss might be far away. But in cryptocurrencies, it could be too tight. That's why I like to use technical analysis before deciding on my stop-loss level. Let's take a look at some real examples using TradingView, a free charting software that you can also use, and you can register for free using the link in the description below. Let's say you're trading the currency pair, Euro-USD. After witnessing a moving average crossover, you decide to go long at 1.0665, anticipating a price rebound from the moving average. Now, it's time to determine your stop-loss level. If you look to your left, you'll notice a previous low that has served as a support level in the past. Additionally, there's a significant whole number nearby, at 1.05, providing extra confirmation. That makes it a suitable spot to set your stop-loss. So we set the stop-loss a little under that level so we don't get stopped out on a quick fake breakdown, at 1.0453, which is a 2% risk. Let's now see a second example that I'm trading the stock of BlackRock. I spot a trend line that had a lot of bounces in the past, and I buy after the price bounced off of a support level, a trend line, and the moving average at 375. I bought 2 positions this time instead of 1. The reason? You will see it on the Take Profit section later on this video. I can place the stop loss under the previous candlestick on our left with some extra room again at 360. That is about 4% risk. So here we have as our protective area, the support level, the trend line, and the moving average. Good possibility this is going to be a good trade. But we will see in a while that we will talk about this example again, but for the take profit level. Now, let's talk about setting take profit targets. But before we move forward, I'd appreciate it if you could take a moment to subscribe to our channel and give this video a thumbs up. It's completely free and supports the growth of our channel. Your support allows me to keep creating free content like this for you. Plus, subscribing ensures that you'll be notified when I upload new videos, including the next one on how to trade based on chart patterns. All right, let's get back to it. A take-profit target is the price level at which you intend to close your trade and secure your profits. When setting your take-profit target, consider factors such as the current market conditions, support and resistance levels, and potential price movements based on your analysis. Here are some tips for setting an effective take-profit target. Use technical analysis tools such as Trendlines, support and resistance areas, whole numbers, chart patterns, and previous lows or highs to identify key levels where price might reverse or encounter resistance. Aim for a risk-to-reward ratio that aligns with your trading strategy. For example, if you're risking 10% on a trade, your take-profit target should aim to yield a reward that is at least equal, double, or triple your risk. It's important to remember that you should set take-profit targets that are achievable based on the current market conditions and price action. Avoid setting overly ambitious targets that may be difficult to reach. Finally, instead of putting all your money into one trade, you can split it into 2 or 3 smaller trades. Here's how it works. Let's say you're willing to risk 9% of your money. Instead of risking 9% in one trade, you can risk 3% but in 3 trades. Each trade will have the same stop-loss level, but a different take-profit target. The first trade might aim for a 1-to-1 risk-to-reward ratio, the second for a 2-to-1 ratio, and the third can have no specific take-profit target. For the third trade, you can adjust your exit strategy as the price moves in your favor. We'll discuss this strategy further later in the video. Let's revisit the same examples as before, but this time focusing on the take-profit target. First, for the Euro-USD example, where we identified a moving average crossover and entered a long position at 1.0665, anticipating an upward movement. Now, you can zoom out and analyze the market structure once more. Looking to your left, you'll notice a significant resistance area between 1.14 and 1.155. A realistic take-profit target could be slightly below this resistance area at around 1.1375. This represents approximately a 6.66% profit, which equates to a 3.35 risk-to-reward ratio. All set to proceed. For the second example involving BlackRock, where we bought after the bounce of the support area, the trend line, and the moving average, I entered with 2 positions, dividing my risk in half. This means that if I allocate 5% of my portfolio to one position, I will invest 2.5% of my portfolio per position when purchasing 2, as demonstrated in this example. Zooming out again and looking to our left, we can see a resistance area between 396.5 and 399, where the price recently bounced twice before retracing. That's going to be our first take-profit target at around 395.5, representing a 5.5% profit, equivalent to a 1.37 risk-to-reward ratio. We will not set a take-profit target for our second position. Instead, we will focus on trailing the stop-loss, as we will learn in the next part of this video. Now, let's move on to trailing stop-losses. A trailing stop-loss is a dynamic stop-loss that you adjust as the price moves in your favor. It allows you to lock in profits while giving your trades room to breathe and capture potential upside momentum. Trailing stop-loss is particularly useful in trending markets where prices can move rapidly in one direction. There are several methods for trailing a stop-loss. First, technical analysis-based trailing stops, such as trend lines. And second, chart pattern-based stops. For example, after a higher high and a higher low, trail the stop-loss under the most recent higher low, and the opposite for short trades. You can also use moving averages as your level to trail your stop-loss. This means you adjust your stop-loss under the moving average for long trades, or above it for short trades, as the price moves in your favor. Choose the method that best suits your trading style and risk tolerance. You should also determine the parameters for your trailing stop, such as the percentage or distance from the current price. Ensure that your trailing stop distance is wide enough to withstand market noise, but tight enough to capture meaningful profits. Monitor your trades regularly and adjust your trailing stop-loss levels as the market evolves. As the price moves in your favor, consider tightening your trailing stop to lock in profits and mitigate downside risk. Now let's look at 2 different ways to trail the stop-loss. One example is for the Euro-USD trade, where we only have 1 position, and the other is for BlackRock trade, where we have 2 positions. In each situation, we'll act differently. On the Euro-USD, imagine your trade is now in profit and the price has risen from 1.0665 to 1.095. you notice the price broke through a small resistance area between 1.076 and 1.0865. So you could move your stop loss up to your entry level, making your trade risk-free. If the price keeps going up and nears the next resistance level, you could keep trailing your stop loss to lock in more profits. In this example, the next resistance level is at 1.1375, which we've set as our take-profit level. You have two options: leave the stop loss where it is, or trail it under the 100-day moving average, or under any other significant support area if there is one. On this example, we will trail it under the 100-day moving average. As you trail the stop loss, you see the price hit our trailing stop loss at around 1.2027 level. This results in a profit of about 12.8%, while risking 2%, giving us a risk-to-reward ratio of 6.4. A great trade just by trailing the stop loss. Now let's look at the second example of the BlackRock trade. We bought two positions at the 375 price level. As the price rose, we hit our first take-profit target at 395.5, giving us a profit of 5.5%. We then moved the stop loss of our second position to break even, meaning the entry level. This makes our second entry risk-free. We can now trail the stop loss of our last position in two ways. One way is to adjust it each time the price makes a new higher low, like around the 410 level. Alternatively, we can trail it under the 100-day moving average trend line or any major support or resistance line. In this example, we chose to trail it under each new higher low. You can see that the price makes the first higher low at 410, and we trail the stop loss under that level. Later on, it happens again at 460, we trail again. Finally, it happens again at around 508 level, we trail again. After adjusting our stop loss following a new higher low, we eventually got stopped out at 495. This resulted in a profit of 32%, while risking 4% per position. So here's the end result. First trade, 5.5% profit with a risk-to-reward ratio of 1.37. Second trade, 32% profit with a risk-to-reward ratio of 8. Another successful trade. I hope these examples helped you understand how to set stop-loss levels, take profit targets, and trail stop losses. If you have any questions about this approach, feel free to ask in the comments, and I will answer each one of them. Mastering the art of setting stop-loss levels, take profit targets, and trailing stop losses is essential for successful trading. By employing these techniques effectively, you can optimize your risk-reward ratio, protect your capital, and maximize your profitability. Remember to always trade with discipline and follow your trading plan. Subscribe to stay informed for more valuable insights in our future videos. Happy trading!